Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. News that's just coming in, India's consumer price inflation has dipped after 3 months and it's fallen below 7%, in fact to 6.77% from 7.44%, and that base effect driven easing of headline inflation is good news, in some ways unexpected, because food prices have also dropped. But what does this really mean and what lies inside that data? Joining me to decode that is PK Basu, the Chief Economist of ICICI Securities. Welcome, Prasenjit, to the show. You've had some time to digest the latest numbers. We've seen the wholesale price data come in. Tell our viewers, what does this easing in the rate of retail inflation, or what is called the consumer price index inflation, really mean?
Well, what it means is that the pace at which prices are increasing has eased off. So we were seeing inflation above 7% for the last 3 months, and that was definitely a major cause of concern to the RBI, given that the RBI has a mandate to keep inflation in the 2 to 6% range. It is still well above that at 6.77% year on year in October, but it is beginning to ease off, and the news is likely to get a bit better going forward, partly because the Kharif harvest is currently underway, and that is likely to have been a very strong harvest, which will help to further moderate food prices. So as food prices come off and food inflation eases, we should get slightly lower inflation going forward. In addition, I think it's important to understand that Brent crude prices between October last year and March this year averaged about $90 a barrel. So in year-on-year terms, oil and energy inflation is unlikely to be particularly high in the second half of the fiscal year. That is October this year to March next year. We'll see base effects helping on the energy inflation front. We've already seen the impact of that in the latest WPI number. WPI, of course, has a very big weight for fuel, much larger weight for fuel than CPI does. And so we've seen the WPI inflation rate come down to 8.39% after being well in double digits for almost a year. So those are all pieces of good news on the inflation front. The worst is behind us. And we've also seen that in the US, the worst is perhaps behind the US. So a global moderation in inflation is a good thing.
Prasenjit, since you speak about the worst is behind us, what about core inflation? That doesn't seem to have fallen. Should we be concerned about that, or is it time to sort of break open the champagne when it comes to inflation?
Well, in India, we don't look that much at core inflation. And the reason is that food and energy are very important parts of the consumer basket for Indians. You cannot ignore food. And so core inflation is a nice theoretical concept for us, but food inflation is really important. And food inflation has been above 7%. And remains. It has just come close to 7% now in the latest month. And really the key for us is that needs to come down. Now, if India was like the US and we were targeting core inflation, then the RBI wouldn't have had to send a letter to the government explaining why it has been missing the inflation target, because in terms of core inflation, we were below 6% for several months anyway. So it hasn't moderated substantially further.
Okay.
But the point is that it's not, core inflation was not as much of a problem in India as it was, say, in the US. relative
And
to
what
the
ab-
inflation target.
and what about the reversal of the base effect as far as the number goes? At some point, we will see that happen. Will that mean that we could see it building up again from December, January onwards?
Well, actually, the base effects are going to be very helpful from January onwards because remember,
Mhm.
it's really since January that inflation edged above 6%. So as we go forward, January, February, March, and beyond, base effects are actually going to be very helpful
Okay.
because this year, calendar year, we've had relatively high inflation. That's one thing. The second is, as I've said, the oil effect is going to be particularly helpful. It's very unlikely that oil prices are going to surge too much above $90 a barrel. They are currently a little bit above $90 a barrel, but it's not going to be too much higher than that going forward, given that global oil demand is coming off as the developed economies go into recession.
In fact, it's interesting you touched upon crude oil, because what we have for our viewers is the latest update that's just come in a little while ago. The OPEC, which is the oil producing bloc of nations, the largest producers included in that, it has slashed its outlook on the growth in oil demand for 2023 as well as for the remaining part of 2022, and it says that demand growth forecasts are challenged because economic concerns are mounting. And I'm going to read out that exact quote, viewers, so that you can understand what really the OPEC has in mind. And then I want to come back to Prasenjit about a different question from a domestic perspective. OPEC says the world economy has entered a period of significant uncertainty and rising challenges, and that is obviously going to impact, in OPEC's view, demand. And when demand for oil falls, that clearly means that not all engines of the global economy are firing. And we saw one of the most rare instances of a oil demand fall immediately after COVID, but that's not what we are discussing here. Prasenjit, let me come back to you about what I call the artificial suppression of the retail price push of petrol and diesel to the Indian consumer. In the last several months, if memory serves me right, 6 months at least, the Indian consumer has been protected. Now, I can't exactly plot what would have been the consequences, but if you have given this matter a bit of thought, do you think that by adding natural price changes, our inflation data improvement would not have been so?
Well, I think it's very interesting that you raised that because we've just had COP27, where the world was meeting to consider what to do about climate change, and I think this government over the last 8 years has been really taking the lead globally in ensuring that even when oil prices come down a lot, the full benefits don't flow through to the consumer in India. Because India is a big net importer of oil, and being a big net importer of crude oil, um, India needs to move away from dependence on fossil fuels. And so, what this government has done really quite well, I think, is that it has ensured that the relative price of oil compared to renewables uh, steadily moves in favor of renewables over time. And to do that, they've kept the taxes on the excise duties on oil products relatively high. And as a consequence, there was a little bit of headroom. Last year, at the end of October, there was one cut in the excise duty rates, and then earlier this year, and I think in May or June, we had another cut. So there have been these cuts. In addition, um, the government has imposed export duties to deter exports of petroleum products. India is a significant exporter, interestingly,
Yes.
of petroleum products. So now there are still some export duties in place to deter exports, and all of that is helping to moderate domestic oil prices. the fact that excise duties domestically have been lowered a little bit, and and export duties have also been put in place. So those have helped. Now, the important point, though, is that in the long term, I think this government's attitude to energy is very clear. It doesn't want to allow oil prices to be too far from where world prices are. And in addition, when oil prices come down globally, they don't come down as much in India because excise duties stay as a means of ensuring that the energy transition continues in India. And I think India is now beginning to be uh, uh, praised around the world for having taken such a stringent stand in ensuring that India is able to move away and encourage the energy transition.
All right. That's a good point. And as we were speaking about the oil subject, viewers, just to point out that the Indian crude basket, which is really what influences pricing in India and is comprised of different kinds of crude that our refiners import, that's up almost $3.50 at 92.4 dollars to the barrel. So some pressures building up, but the overall trend as far as crude is concerned is headed downwards, and this is significant from not just what Prasanjit said to you. Also remember that there is a fiscal impact that was partially absorbed by the central government, and since we are heading into budget season, that perhaps may require another separate discussion with Prasanjit. But let's come back to inflation. We have seen the wholesale price inflation data, we have seen IIP. Now, all of this put together, the next questions that I have for you, starting with the first one. What does this all mean for growth? We have seen largely a downward revision of different estimates by most pollsters on India's economic growth prospects for the current year. Where do you stand now with the latest data and what the RBI has been doing?
Well, I think that first of all, the RBI will have to raise rates at its December meeting. And I think they'll take it up to 6.25%. I haven't changed my view on that, uh, which basically means another 35 basis point hike. But I think that is the end of the hiking cycle for India. And it's going to be helped by the fact that by January or February, we'll see the headline CPI inflation rate come below 6%. And once that happens, then there is really no need for the RBI to keep raising rates because already with the December hike, we'll be at 6.25%. So we would have restored a positive real rate. Now, in terms of growth, I think that the second quarter is going to be a bad one. There's no question that there was a very sharp deceleration in industrial production, particularly in August and July. There was some improvement in September, and I think improvements will continue as we go forward. But what really is striking to me is that investment spending is picking up. We are seeing capital goods output continue to do well, and capital goods imports are growing strongly. That is suggestive of a recovery in fixed investment spending. And that really is the key to the story going forward. Also, I think we've had very strong revenue growth. Direct tax revenues, in particular, have been very strong in the first half of the fiscal year. And so the fiscal deficit is well below what is normal. Normally, in the first half of the fiscal year, you get a deficit that reaches about 80% of the full year target. This year, it's only about 35% of the full year target. So that is going to ensure that the actual, with strong revenue growth, the fiscal deficit is going to be lower than the official targets, and that will help to crowd in private investment. So I have not lowered my growth forecast for India. I continue to expect that this year we'll see 7.5% real GDP growth. That is well above consensus. Most forecasters are now at 7% or lower. But I think that investment spending will ensure that we get a strong economic story for the rest of the year. Of course, the second quarter of the fiscal year will be the weakest.
I'm glad you said that, because that's a pretty solid forecast to have at a time when people are sort of punning on the magic of the 6.5% number, inflation at 6.5%, the repo rate at near about 6.5%. So that was becoming the sort of magic number when it comes to the big macro data. Let's focus further on the wise men and women of the Monetary Policy Committee. Fundamentally, if inflation has been higher than the upper end of the tolerance range for 10 months and the MPC has taken successive rate decisions, by when do you expect those past decisions to translate through into impacting inflation? Because much of our inflation isn't really amenable to monetary action. So the basic logic of why would you make money costlier for a capital starved country like India is something that keeps bothering me, Prasenjit, and I'm trying to get you to comment on that.
Yeah. Well, I think the important thing to understand here is that uh, you're absolutely right. Monetary policy on its own cannot fight this inflation problem. Part of the inflation problem is supply driven, it is global supply driven. And we have a global inflation problem at the moment. Uh, and India has succumbed to that as well. But uh, to the extent that the RBI can do anything, the RBI has already had some impact. We've started seeing core inflation moderate. If monetary policy has any impact on inflation, it really should have an impact on core inflation. Uh, Monetary policy cannot do too much about the supply of food and fuel. And so what is happening now is that
May
a
I just
confluence
interrupt
of two
you?
things are going to help.
May I just interrupt you here? Sorry for that interruption, but just to take that point and drive it further, would I be right in arguing that the bigger impact when it comes to consumer prices has been the fiscal action of not hiking petrol or diesel prices, and a significant borne by the government of India, which has been made available to the OMCs to fill that hole in their balance sheet? So what I am trying to say is that the government's action on controlling the fuel pass through has more impact than the RBI's, and that's why how long can you continue to make money costlier, which impacts downstream borrowing of all manner, Prasenjit?
Yeah, no, you see, now this is a relatively minor factor this time around. I mean, when you compare it to say 2013 and previous episodes of high uh, uh, bills for the OMCs being borne by the government, etc., this is really quite a modest
Fair
amount
point.
of an impact. First of all, that the second point there is that. Um, I think the government has a lot of headroom in terms of excise duties. It can cut those further. Given that other revenues are doing so well, it is possible to cut excise duties. That's one factor. The second is that right now, um, fuel prices, Brent crude prices, have come off. So when we are close to $90 a barrel, as opposed to 105, 110, 115, there isn't as much of a concern. So we are now at a much more acceptable level. As long as Brent is close to $90 a barrel or below $90 a barrel, there is really not much of a problem for India. And
Prasenjit, what
at
would
least
be the
in
downside?
terms of the headline inflation.
What would be the downside if the MPC were to pause? Apart from the surprise that it may deliver to professional RBI watchers, what would be the downside in real economic terms?
Well, if the RBI were to pause in December, that is, not hike at all in December, then one of the impacts would be that the rupee would resume depreciating. and a depreciating rupee would actually cause inflation
and
to pick up.
you are saying
Now, what I think
you would say a
here it's
resumption.
important to understand one
No, you
important
are.
factor here is that um, we now, over the last few trading days, or actually over the last 2 or 3 weeks, we've begun to see the dollar lose some of its steam. The dollar has had a spectacular run in the year to October, to the end of October. The dollar's trade weighted index was up 19.9% against all currencies.
That's right.
Against the rupee, it was up about 9% over the year. So the rupee has actually outperformed most of the world's currencies. But the dollar is really the key in terms of imports. Most import prices are dollar denominated,
Yes.
and that 9% depreciation against the dollar has, of course, contributed to inflation. I mean, we mustn't forget. But as we go forward, it is increasingly likely that the rupee and other currencies are going to begin to strengthen a bit against the dollar, given that the dollar has been too strong for too long. The currency markets are going to start focusing on the prospect of a recession in the US. And once that becomes more of a focus than the fact that US interest rates are going up and up, then the dollar uh, will begin to lose momentum, as it indeed has in the last 2 weeks. So if the dollar now begins to depreciate a bit against the basket, that'll be very helpful, and I think that too will contribute to helping us on the inflation fight. Now,
For the sake of argument, for the
so my
sake of
point then is that
for
we
the
should not,
sake of
India should not go out of the global sort of tightening mode right now. There still is a little bit of a need to tighten, given that 6.77% is still above the 2 to 6% range for inflation.
for the sake of argument, if I were to say that the reversal in FPI inflows that we are seeing into our markets at least means that there will be some relief of sorts for the rupee, wouldn't you say that that's also a real factor that needs to be kept into account?
Yeah, well, FPI flows have actually turned positive, net positive, since the second half of July, and that definitely has helped to stabilize the rupee. But I think the really important factor here is that India has relatively low levels of external debt. Most people have begun to notice that India's external debt to GDP ratio at 19% is really low relative to most of the world. And consequently, uh, there are good reasons why FPI flows have come back and have contributed to stabilizing and strengthening the rupee. But if if the RBI were to buck the trend and not raise rates in December, then I think we could have another leg down in the rupee, and that is best avoided.
Well, Prasanjit, that's a very good answer. As I try and sort out the tangled signals, at least from my perspective, that the economy keeps throwing us, different data have different sort of colors and meanings attached to it. But I'm going to end this conversation today by telling you that the Indian markets gave a spectacular thumbs up on Friday to US inflation easing. And I'm wondering whether come tomorrow, Tuesday, the Indian markets will once again read this latest number as maybe not as much as Friday, because Friday, the second part of the rally, at least in the trigger terms, was the easing of COVID restrictions. The big thing that's been weighing on markets all over is China's zero COVID policy. And after the Chinese Party Congress has gotten over, people are saying, well, it's going to get eased up a bit, and that therefore means that the world's manufacturing engine may start chugging fully, and that would reduce supply side issues. But when it comes to inflation, let's wait and watch what Tuesday has in store for the markets, and we will bring you through the day tomorrow as we always do on market days, daily commentary, analysis, and expert views from guests like PK Basu, who joined us today to decode the latest inflation numbers and make sense of the real economic news beyond just those headline numbers. PK Basu, thank you very much for your time. With that, it's a wrap on today's episode of Easynomics. Do continue to like, share, and subscribe Business Today on YouTube and tune in on all our platforms, including businesstoday.in. I'm going to say bye and see you again tomorrow, same time. Till then, have a good time.